Okay, so what's 1221, 2 and 3 say? Who was the last person?
Me.
Do you want to call him? Sure.
Really?
Kaylee, what we got? What's 1221 or 1222, 1223, 1 and 2 say?
1223-1 is holding period of shares received that were received under section 351 tax deferred event is equal to the holding period of the assets transferred.
Okay. What's 2 say?
And holding period of assets held by the corporation under tax deferred event are equal to what was in the transferor's hands.
Okay. So it's called tacking of the holding period, a tax on. So I added an acquisition date of 5/1/21, and we have the same transfers. What is the holding period of the stock under A, Kaylee?
Assuming the holding period is 5/1/21.
5/1/21, because that's what 1223(1) says. You reference the holding period of the asset transferred. So the asset transferred was originally acquired on 5/1/21. Therefore, the stock that you received has a holding period that starts 5/1/21. What about B or 2? I labeled it here. What's holding period for B?
5/1/21.
5/1/21. What about C?
Either 5/1/21 or the date of the transaction.
Either.
That's what it says. I don't know why.
Does it say either on there?
It depends.
Well, on the bottom.
It depends. Jack's going with the tried and true depends.
Oh, if we're looking at shares. Oh, then it's just 5/1. Sorry. 5/1/21. I was looking too far down.
See, I don't know if my instinct is it's 5/1/21. I don't know that for the shares. And what are the two answers, Sam, that exist in the world that we should adhere to?
I don't know.
I don't know, and the correct answer.
Yeah.
So when I don't know, I say I don't know. I'm not sure about C and whether the holding period. I have 2 holding periods, which is associated with 5/21 for the asset transferred, plus a new holding period associated with the 250 for debt in excess. I don't know that either way. My assumption, my thought, I think, is it's 5/1/21. That's my instinct for the shares. However, for the corporation, 168I7 says what? Lane, what your? It's step in your shoes, step in the shoes, and we'll cover that. But for a depreciable asset, I transferred a depreciable asset that was acquired on 5/1/21. That depreciable asset had a cost basis. It had an accumulated depreciation. It had a tax net book value, and it had a remaining life that it had to be depreciated out that's left. So if it's a 5-year asset and I'm on year 3, I got 2 years left. So it comes with acquisition cost, accumulated depreciation, and 2 years left to be depreciated. That's what 168I7 says. Step in the shoes. You just take the depreciation schedule that existed on the partnership, you pick it up, and you give it to the corporation with no change. That's what step in the shoes means. But the 250 that is gain in excess, that is brand new. That now is going to be depreciated over 5 years because there was a gain associated with that, and it's a brand new asset of the corporation. Now, that's with this C1, C2. C1 is the tax net book value of 250, which you have acquisition cost of $1,750,000 of accum, 2 years left. 168I7 says that stays the way it is, but the 250 that was the gain due to 357C is a brand new asset being depreciated over 5 years. And the acquisition date is the date of the transaction or the transfer to the corporation. So I don't know if that's helpful to put a post-it there and highlight the C2 just so you know that the gain in excess has a start date. So I don't know if I cover this. I suspect that I do. But let me ask a stupid question. Sam, call on somebody.
Okay. Trent.
Do what? Are they picking on you, Trent?
What?
Are they picking on you?
No, it's okay.
Okay. So these are capital accounts. Trent, do we have a positive capital account and do we have a negative capital account?
The one with the arrow pointing to it has a positive capital account.
Okay. What about the other one?
Negative.
How does one get to a negative capital account?
Typically by taking losses,
In excess of?
debt basis.
In excess of what you put into it. Okay. So let's do simple debits and credits for a second. If I put in $100 and there's $100 of cash, and then I have equity of 100, and there's the only thing we have is $50 of expense. Spend the $50, my capital account goes from 100 down to 50, right? Now, put in 100, take out debt of 100. So I have 200 of cash, 100 from my contribution, 100 from debt. So my asset side of the balance sheet is 200 of cash. Liability side is 100 of debt and 100 of equity that I put in. We spend $200. What is my capital account?
Be 0. Wait, what was it before? It was 100? It would go down to negative 100.
Be negative 100. So the punchline is I have debt-funded losses. That's what drives a capital account. It's a debt-funded loss. So now, if I say, hey, we're going to file, what's that form, Lucas? To make an S election, it's also check the box. 2553. Okay? So we do this all the time. Do we not, Ben?
All the time.
All the time. But the thing that you need to ask yourself is there a negative capital account? What's 357C say, Lane?
These codes, I can't remember.
It's our second stop. Do what?
Capture the gain. So
Capture the gain, but how,
excess of
debt in
basis.
excess of basis. Does that negative capital account look like it's debt in excess of basis? It is, based on our simple debits and credits, right, Trent? So when we do these, the 2553, and now we have to run the traps starting at 351, going to 357C because we're going to capture the gain. We want to capture the gain because we want to populate our formula in 358, which is old basis plus gain recognized plus boot paid minus boot received. We got to capture the gain, then we got to go to 362, old basis plus gain. Well, guess what? That negative capital account represents debt in excess of basis. So you have a 357C problem with this negative capital account right here. And for those that are paying attention, this is going to be captured under 84-111, which we're going to be talking about. Okay, so remember, oh, I did do it. Damn. Okay. So our basic fact pattern was what? We transferred a widget machine under scenario A, B, C, and D, correct? And I don't know how, this might be helpful if you capture the pages as we go. I have no idea. But we transferred this machine. And we had to stop first where, Trent, to diagnose what?
Tax deferred or taxable.
Okay, and it's tax deferred because we met all three elements. What's our second stop?
357C
And why do we stop there?
to see if there's a gain on debt in excess of basis.
And why do we care if there's debt in excess basis?
So it impacts 358 and 362.
Is that right, Lane?
Captures the gain, so yes.
For which sections?
358, 362.
358 and 362.
Writing them down.
Okay,
I
good.
don't remember them.
And then, so 358 is shareholder basis, 358 is, or 362 is corporate basis. So all these now help us construct our opening balance sheet and our opening basis schedule. So if we look back to 362, 362 says in A, what is the basis in the corporate asset? In A,
750.
750. How much debt was transferred with that?
0.
No. I think, well, so let's go back and look at our fact pattern. How, 500, okay? So you have measured, what was the basis, Jameson?
750.
750. How much debt was transferred?
500.
500. What's the basis that we have in my shares? And this might be something that you infer back and forth somehow to remember this. What's the basis that I have in my shares?
250.
250. So we've captured certain things here. Basis in the asset of 750, debt of 500, and the basis in my shares of 250. We've captured those items, correct?
Mm-hmm.
So now we're going to come down and say, well, let's do an opening balance sheet. Well, 168 I-7 says what, Jameson?
Step in the shoe.
Step in the shoes. Step in the shoes. I got $1 million of cost, acquisition cost. I have 250 of accum, and I have 750 of basis in my assets. What 362 told me that my basis in my assets should be 750, and then we accomplished that. 168 I-7 says that you populate the balance sheet with the acquisition cost and the accumulated. Then, well, how many liabilities went in? 500. So now I have 500, correct? What's the basis I have in my shares?
250.
250. What's my equity section?
50.
So my equity section is going to equal the basis that I have in my shares. So between 168 I-7, 358, 362, you now have the tools to populate your tax basis balance sheet and your beginning basis schedule. And I think I probably make a note, right? Oh, look, damn, it's like I've predicted. Okay, so let's do this. So what's note 1 say? Jameson, who you want to call in?
Tatum.
Tatum, what's note 1 say?
168 I-7 states that the corporation inherits the tax depreciation schedule of the transfer. The corporation steps in the shoes of the transfer.
So Tatum, that's why we have $1 million of acquisition cost and whatever the accum is on that balance sheet, correct?
Mm-hmm.
So that's what 168 I-7 says. What's note 2 say?
Basis in assets due to transfer gain starts as a new asset for a holding period and depreciation.
So that's the 250 there, right?
Yep.
Tatum, correct?
Mm-hmm.
Okay. And then what's note 3 say?
The tax basis, equity, and shareholder basis are equal.
Okay. This almost feels like this is a post-it worthy page to me. When I originally wrote this, Tatum, who you want to call in?
Disler.
Disler? What's number 1 say?
Revenue ruling.
No, what's the top of the page say? Sorry.
Uh,
Because I cracked myself up.
351 items not covered well or at all.
Okay. So what's number 1 say?
Revenue ruling 84-111, methods of incorporating partnership. Just kidding. This is common enough. I covered it. See the next pages.
Yes. So we're covering 84-111 because we check the box all the time. Okay, revenue ruling 77-37, accommodation transfer. Jack, who you want to call in?
Chambers.
Who?
Chambers.
Chambers. Okay, at the very beginning, I said that there were 3 elements to diagnose whether a transaction was taxable or tax deferred. Is that correct? And what were those 3 elements?
Not remembering.
You can call on somebody else, Jack. It's okay.
Thomas.
Thomas, what were the 3 elements?
What was the question?
What are the 3 elements of 351 to diagnose whether it's taxable or tax deferred?
There was a transfer,
Transfer of
property,
property,
stock received,
sold in exchange for stock,
Yep. and then ownership over 80%.
control,
Control.
ownership over 80%. And which one is the hardest to diagnose?
3.
Which is?
Ownership.
Control.
Or control.
Okay. So 7737. So let me ask a stupid question. You have, what were the 2 categories that you or subset categories that 351 could be used? Was it existing and new, Thomas?
Yeah.
Yes. Okay. So Pete owns X. The fair market value of X is $10,000. Thomas and I want to get into a venture together, and he has ground that's worth $10,000. But it has basis of 1,000. What's your gain, Thomas, inherent in that ground?
9.
9. So if you transfer, I have 10,000 of value, you have 10,000 of value. If you transfer your land to X, and I own 100 shares, how many shares do you think you should get?
Half.
Well, no, just 100. You'll own 50% of it.
Oh,
The
okay.
corporation's going to issue 100%, 100 shares to make us 50-50 because that's the economic deal. So 351 would say that you have a taxable event or tax deferred event.
Deferred because our ownership together is 100.
Did I transfer anything?
Oh, no.
So am I part of the transferring group?
No. So it's taxable.
It's taxable. You don't like that, do you? You want it to be tax deferred, right?
Right.
So, well, fine, Thomas. Guess what I'm going to do? I'm going to transfer, you're going to bring in your land, and I'm going to bring in $10 of cash.
Can you actually do that?
Well, this is point number 2. No, you're good. You're dead on it, Sam. You're 100% dead on it. Because why did you ask that question? Does that feel like it's bullshit?
Yeah.
Yeah. Okay. So, was I a transferor, Thomas?
Yep.
Were you a transferor?
Yeah.
What percentage should we own after? This
100.
transferring group?
Together? 100.
100. Is this bullshit or not?
You tell me.
No. What's your instinct?
Yes.
I would say yes.
Yes. 7737. That's what the point of 7737 is. It's called an accommodation transfer or. You cannot be an accommodation transfer or and be counted in the transferring group.
So how are you not considered an accommodation transfer?
Oh, somebody that asked a very good question. That's a Scooters worthy question.
Wow, thanks.
Because that is paying attention. Okay? Jameson, how you feel about this? Somebody else getting a gift card.
I got one right now.
You do? Okay. So, how does one become not, how do you get out of these rules? That's your question. 7737 says that you have to transfer 10% of your pre-value amount. So in this case, for me to be counted as part of the transferring group, I'd have to transfer not $10, I'd have to transfer $1,000. That's what 7737 says. In-depth discussion of 368C. I mean, we're getting there, but I mean, there's a lot to control. Contractual obligation to sell shares prior to formation of 351 does not count for 368C. And Ben earlier, to answer Jack's question of, is a new corporation always going to be a tax deferred event? And Ben said, well, wait a minute. We might want to manufacture into or automatically try to fail the corporate formation rules to get it to a taxable event. Did you not?
Yep.
Okay. So if we have, and I've used this because, do we do a lot of Kiewit shareholder work, Ben? Fair enough.
Sure.
Kiewit shares. Oh, Sam. Are Kiewit shares, can you sell Kiewit shares?
No, not unless you leave.
Not unless you leave. So if I am a Kiewit shareholder and I'm going to retire, hey, Nicola, what's my goal?
To retire?
To retire. That's why I'm doing this, right?
Yeah.
What do you mean? Eh.
I think you were forced to do this, but
Do what?
I think you were forced to do this.
Nobody forces me to do anything, Nicola. Okay, so fair market value, I'm going to call it $20 million. Sam, are there people at Kiewit that have $20 million of value?
Yes.
I would assume so.
Oh, there's people with billions.
No.
Not a billion, maybe. There's some big boys out there. So tax rates are changing, are they not? They're changing. So now, can I sell my shares, Sam?
Not unless you're retired.
Not unless I'm retired, but I'm going to retire 2 years from now. And what's the general appreciation of Kiewit on an annual basis? 20%.
Okay.
Okay. 20%. 20% times 20 million is 4 million. So I don't want to sell them because 4 million a year means I got another 8 million coming to me. I'm not going to sell. The tax rates are changing, and I got zero basis in these. So therefore, I got 20 million of gain sitting there. And if tax rates go up 10%, 10% of 20 million is how much, Sam?
200. No. Yeah. Wow.
2 million in tax.
Yeah.
So by virtue of not being able to pop this gain, I can't sell it. I want my $8 million of appreciation. But I want to get in under the deadline of the tax increase. So what do we use 351 for, Trent?
Diagnose if it's taxable or tax.
To diagnose whether it's taxable or tax deferred. So you can not only diagnose it, you can use it. So if somehow you fail, you're never going to fail transfer of property. You're never going to fail issuance of stock. Those two you're not going to fail. So where can you fail if you want to fail?
80%.
The control. So if we look at contractual obligation to sell prior to the formation of the company. And control is defined as 80% of all classes of stock, vote and value. That's the definition. So what happens, Trent, if I'm the guy with $20 million, I wish. I wouldn't be here, you guys be on your own. And I'm going to transfer, well, hold on. I know I'm going to create X. And X is going to have 9,500 voting shares and 500 non-voting shares. I know that's what it's going to have. It hasn't been formed yet. And I say, Ben, I'm going to sell you 500 non-voting shares. So Ben and I go to the attorney, and we get a contract for Ben to buy the 500 shares. Hasn't even been formed yet. So now we've entered into this contract where I'm obligated to sell those shares. Contractual obligation to sell shares prior to formation don't count for control. So now the contract exists. This is one. I transfer the 20 million and I get voting and non-voting shares. Now Ben executes on the contract that existed prior. I have to now sell my non-voting to Ben, and now I measure control. Do I have 80% of every class of stock? Yes or no? I don't. I have 0% of the non-voting. So now, since I have 0% of the non-voting shares, I fail 351. And my diagnosis of that transaction, Trent, is binary. What's my two choices?
Taxable or tax deferred?
What category does this fall into?
Taxable.
Taxable. So my inability to sell those shares back to Kiewit to get ahead of the tax rate change, I can do it this way.
You do a lot of planning
Do I?
then, probably.
This is a double-edged sword. And the first time I did it, worked like a charm.
Okay.
Second time, I'm like, oh no. It didn't work. It was a disaster
Okay.
for lots of reasons. Lots of reasons.
But they probably have to do a lot of tax planning. I never really thought about that.
Do what?
They probably have to do a lot of tax planning.
The Kiewit people?
Yeah.
Yeah, they do.
And I never really think about that.
Oh yeah, they do a lot of planning. Let's see. Shares issued for services don't count for control. So I'm going to do the accounting work to get the thing set up, and I'm going to get 100 shares. Those 100 shares don't count for control. I'm not part of the transferring group. 351E, which there's a corresponding thing in a partnership that says if you are putting shares into corporation and it's an investment corporation, this doesn't count for deferral. So I'm going to give you a brief example of what that means. I have $20 million worth of Kiewit stock and no other assets. Ben has $20 million of Apple, Google, Tesla, GE, Ford, whatever. He has lots of shares. Ben and I are friends. I don't want, he says, look, I'll take the upside of Kiewit and I'll allow you to diversify off my portfolio. So we both put our investments into a corporation, and now I've diversified my position. If you measure diversification, then you're an investment corporation. And if you're an investment corporation, that doesn't count for 351. It's taxable. Property received as boot.
So at what point are you, like, if you just put Kiewit stock in?
Yeah.
You're not an investment corporation?
No, because I'm equally at risk whether I hold it by myself or in the corporation. It's if I diversify my position by virtue of you coming in.
So if Ben, who has stock in 8 different corporations, decides he wants to put said stock into a corporation, but still has 100% of the stock.
There's no diversification.
Okay.
Because, effectively, I took 50% of my Kiewit shares under our deal and sold them for 50% of yours. Because I've now diversified. You've given me some diversification protection and minimized my risk.
I have a question.
Yeah.
Is there any limitations on the type of asset? This might be so dumb, but the type of asset that you can put in a corp, like, can Kiewit be like, you have to hold this yourself. You can't put it into like a corporation. Can businesses do that?
I think that would be a business or legal issue and not a tax issue. I mean, where somebody says, I want to guard myself from that toxic waste dump, or we don't want to engage in that, but it's not, other than, there's not a prohibition of being an investment corporation. It's just it's taxable event. Now this page here, I think, might be notepad or post-it worthy. Because at the end of the day, this kind of summarizes what we've talked about for the past however long we've been in here on 351. Because this says, what are the elements of 351? Transfer property to corporation, transfer or receive stock from the corporation, transferring group has control immediately after, as defined by 368C, which is 80% of all classes. Basis formula, 358, basis in shares, old basis plus gain recognized plus boot paid minus boot received. Debt's part of that, old basis plus gain recognized by transferor, that's 362. You have your tacking, 1223, 1 and 2, and 168 I-7. Right, this summarizes in a spot the traps you got to run. It doesn't tell you how to run the traps, but at least it tells you what you have to confront when you have transfer property to corporation in exchange for stock. This is a decent summary.
Before we move on.
Yeah.
When there's the gain piece, are there presentation requirements for how it's presented, like on the balance sheet on the tax return?
There is a 351 statement that's attached or should be attached, which might get ignored some. And the reporting of the gain is going to be at the shareholder level. And that, being a self-reporting compliance system, if you don't report it, you don't report it. And we do run into this where we have that negative capital account or something where the taxpayer says, well, whoops, missed it. So there's not a trigger mechanism. There's not a form. There's not like an 8824 for like-kind exchange. There's nothing like that. The only thing that I can think of that exists is a 351 statement.
And so like the entity itself doesn't have any responsibility for the individual to like report anything.
There's not a W-2, there's not a K-1, there's not any sort of document that calculates and inflicts that. Now, given the way the IRS has trended with hot assets and fucking K2, K3, and the M2 or M3, there's lots of things that, and the 7203. What's that word over there? Retire? All that makes me want to retire. I hate it. I do, with every fiber of my being. So it would not surprise me if there was some reporting at some point in the future that said, if you have a gain due to 351 and it's a new corporation or existing corporation, you're required to file the failed 351 form, whatever that is. There's nothing that exists to my knowledge for that. Huh. Oh, let's see. Who was the last person? If you just say me, you get to call on somebody.
Me.
Who said that?
Me.
Oh, you want to volunteer, Nicola? Who you want to call on, Nicola?
I'll go Lucas.
All right. Lucas seems pretty pleased. What's to say, Lucas?
Pete and Jeff want to form a corporation. They own the following property. So Pete's got land with a fair market value of $1 million. Its basis in land is $200,000. He's got a note attached to the land for $50,000, and he acquired that on May 1st of 1999. And then there's a building, fair market value $10 million, acquisition cost $5 million, and accumulated depreciation $4.5 million. Debt on the building is $950,000, and Jeff has $10 million in cash.
What? Keep going.
Okay. Pete's net equity value is $10 million. That's $1 million of land plus $10 million on the building minus $1 million in debt. And Jeff's net equity value is $10 million. Therefore, they will be 50-50 owners. They form the new corporation. one. Do you want me to read the questions?
Yep.
All of them?
Now let's take them one at a time.
All right.
You
One.
take the first one, and you get to call him before next sucker.
Okay. Is this a tax deferred? Is this tax deferred under 351? I think so.
What are the elements? What are the three elements?
So you put in property.
Yep.
And you get shares back.
Yep.
And they're doing it together. So together they've got 100% of the stock, so they got control.
Okay, so you were able to diagnose it under using those three elements as tax deferred. Okay? Who you want to call in for number 2?
Oh, Tatum.
She looks so pleased. She looks less pleased than you did, and you were a low bar. What do you got, Tatum?
Do either Pete or Jeff have a 357C problem?
Well, Jeff clearly doesn't. What's 350C say?
Debt in excess of basis.
Okay, so stupid question. Let's take it one at a time. What's the basis of the assets being transferred by Pete, Tatum?
200,000 plus 500,000.
500.
5 million minus 4.5.
Oh, yeah. Sorry. I was looking at fair market value. You're right. Sorry. I was an idiot. So what's the total basis?
700,000.
Okay. So so now we've quantified the population of basis of all the assets transferred, correct?
Mm-hmm.
So what is the debt that is being transferred in conjunction with the transfer of that property? How much?
$1 million? Oh, wait. Yeah.
$1 million.
Yeah.
So 357 says gain occurs when?
Debt is higher than the basis.
Okay. So do we have debt that's in excess of basis?
Yeah.
How much?
What did we say before? 700?
700 basis,
So
million of
300,000.
how much?
300,000.
300,000. Everybody tracking with that? Emma, you tracking with that?
Yeah.
Okay. Nicola, you got it? Okay. Tatum, who you want to call in?
Kaylee.
What's the next one say, Kaylee?
What are Jeff and Pete's basis under 358?
Okay. What's the formula for 358 basis?
It's original basis plus gain received
Recognized.
recognized.
Yep.
Minus food paid or plus food paid.
Yep. So what's Jeff's basis? 10 million. What's Pete's basis?
Here.
How do you know?
Because the 357C gain outweighs the
Anytime you have 357C gain, you can automatically default to it 0. But the old basis was 700, gain recognized was 300, boot paid or boot received was the debt transferred, which equaled $1 million. 700 plus 300 minus $1 million gets you to 0. Okay? Who's next, Kaylee?
Lane,
What's the next question, Lane?
what's the corporation's basis in the assets under 362
Okay? What is it?
What's
the formula?
Okay,
yep.
yep.
plus the gain?
Yep.
So it'd be 1 million. Old basis is 700,000.
Yep.
The gain is 300,000.
Yep. Is that the full answer?
I don't know.
Who do you want to call on?
Thomas.
Thomas, is that the full answer?
I think so.
Jameson, how you feel about that?
11 million because you have Jeff.
You have Jeff and his cash. You had 2 transfers of property, so you have to quantify for all of it. Who do you want to call on next, Lane?
I already
Is
told
it-
him someone.
Is there
There is a million.
is there no other questions? Are we done?
Yeah.
There's no other questions?
No, there is.
Well, who do you want to call on for that question?
Natalie.
What you got, Natalie?
Okay. We're on 5, right?
I don't know.
Yeah, we are.
Okay.
What does the depreciation schedule look like under 168 I-7?
Okay. What's I-7 say?
That step in the shoes of the transfer.
Yep. You're very proud. I love it. Okay. And so what's my depreciation schedule?
I don't know.
You can call it somebody.
Try it.
So the building cost, there's what, 500,000 left to depreciate.
Yep.
Are you looking for year in life or
I'm good with you're saying, but you're saying acquisition cost is what?
5 million,
Cume is what?
4,500,000?
Okay. Okay. What else we got?
Land's not gonna get depreciated. Will be on the balance sheet.
Okay.
What else we looking at here? Missing something?
Nicole, is he missing? Jack, is he missing something?
The 357C gain,
And how much was 357C gain?
300,000. That's a new asset.
It's a new asset. So you have the old asset, and that 357C gain has to be bifurcated or split in between the land and the building. So you're gonna have a new portion of the land, you're gonna have a new portion of the building. And I don't know this with absolute certainty, but I think that 300,000 is allocated based on the fair value of the assets being transferred. I think. Do you know? I don't know. Do you see this little hand here, right here?
Yeah.
Okay. What's that say to the right of the hand?
Revenue ruling 84 111 1984.
You can stop to 84,111. So the further that you get and the sooner that you get there, the better off you will be. To understand that there's a hierarchy in terms of what tax law is. The top of the hierarchy is the code. The next piece is regulations. And then somewhere, and I get fuzzy at this point, is case law. And case law is going to be between Supreme Court, Court of Appeals, and then there's all sorts of myriads of various courts out there, which include tax court, district court, whatever. So you have court cases. Then the IRS issues guidance in terms of revenue rulings and revenue procedures. This is a revenue ruling. Then there's private letter rulings and there's other things out there. And these pieces of guidance that are given to you is exactly that, guidance. What is going on? How does this work? And it tells you what the procedure or thought process is on how to approach something. So 84-111 is the incorporation of a partnership. That's what 84-111 is. So there's embedded in 84-111 is situation 1, situation 2, and situation 3. So Jack, why don't you read, and let's, to the best of our ability, interpret what 1 says. Okay, before you do that though, let's talk about you got Jack and you got Pete, and you have land, fair market value, 1,000, basis of 100, and I'm not going to muddy it up with debt just yet. Okay, so 84-111 says, what is the procedure to incorporate a partnership? That's what 84-111 is doing. And they tell you that there's 3 ways under situation 1, situation 2, and situation 3 on how you can accomplish incorporating the partnership. So what's the words under situation 1 say?
X transferred all of its assets to newly formed corporation R in exchange for all the outstanding stock of R and the assumption of R and X's liabilities. X then terminated by by distributing all the stock of R to X's partners in proportion to their partnership interests.
Okay, what's that mean? So let's break it down piece by piece. What's step one in what is the first thing it tells us that we should do?
Transfer all assets to the newly formed corporation in exchange for stock.
Okay, so if I were going to draw over here, Jack, where should I start drawing?
Okay. So the land will be like going to R.
Okay, and then what happens?
R will give stock to X. Yeah.
Okay, then what happens?
R assumes X liabilities, and then I guess that's part of the stock. And then X is terminated by distributing all the stock of R to X's partners. So, yeah, stock goes to J.
Okay.
Yeah.
So, and this is what physically happens, right? 84-111 says the land is transferred to R. R issues stock, and then X liquidates the stock out, and the resting point is Jack and Pete own R. So that's assets up. I think that's what this is called. Assets up, I think. Okay, Jack, who you want to call on?
Jameson.
Jameson, what's 2 say?
Y distributed all of its assets and liabilities to its partners in proportion to their partnership interests in a transaction that constituted a termination of Y under section 708B1A of the code. The partners then transferred all the assets received from Y to a newly formed corporation S in exchange for all the outstanding stock of S in the assumption by S of Y's liabilities that had been assumed by the partners.
Okay, so what's step one?
So Y distributed all assets and liabilities to partners in proportion to their partnership interest in a transaction that constituted termination of Y. So Y should draw arrows to the partners, and now Y is no longer.
No longer exists.
Yeah. So then the partners just have all the assets, and now they're contributing to a corporation S. For stock, so then arrow back, and and S assume the liabilities too, and so now they fully own S.
Okay, so the contributor to the corporation under situation 1 was the partnership. The contributor to the corporation under scenario 2 is individuals because we liquidated the partnership. Okay, so I think this is assets down or something. I don't know. When I read about this in like treatises or whatever, they say assets up, assets down, assets over, and I can never wrap my head around which one's really which. So I have to go through the facts and just kind of figure it out, but I think I'm right. Okay, so Jameson, who you want to call on?
Emma.
Who?
Emma.
Emma, what's 3?
The partners of Z transferred their partnership interest in Z to newly formed corporation T in exchange for all of the outstanding stock of T. This exchange terminated Z, and all of its assets and liabilities became assets and liabilities of T.
Okay, so what's step 1?
The partners of Z transferred their partnership interest to Z into T.
In exchange for T stock. Then what happens?
Z goes away.
So at this point, I gotta come over here. At this point, you have T, Z, Pete and Emma. Z goes away, and how does Z go away?
Because all of its assets and liabilities are going to T.
It liquidates into T. So at this point, the land transfers at that point. And this is, I think, assets over, I think. So 84-111 says there's 3 ways to incorporate a partnership. And 84-111 is making not an assumption, it's making a hard statement that these things actually have to happen. Under this scenario, the asset has to be put into the corporation by the partnership, and then the partnership liquidates. Under this scenario, the ground actually has to come out and then be contributed to the corporation. Under this scenario, the assets have to go into the corporation, the partnership interest has to go in the corporation, and the partnership liquidates. These are tax facts, not tax fiction. So, here's the parlor trick. Do you know the parlor trick, Ben? Basis parlor trick?
I don't know that I know what it's called.
Okay, so everybody knows what a 754 is, right? So Pete buys Ben's interest for $1 million. Ben's basis in his asset, his interest was $100,000. What's your gain, Ben?
900.
900,000. Now, using a rule of thumb, Lane, what should my step up be under 754?
Well, wait, what did you say?
Okay,
Sorry, I wasn't paying.
that's all right. I buy Ben's interest for $1 million. Ben's basis is 100,000. Ben's gain was how much, Ben?
900.
900,000. As a rule of thumb, what would you expect my 754 step up to be on the assets?
900,000.
900. That's a bad rule of thumb to use. I mean, it's let me rephrase. It's a dangerous rule of thumb to use, but it is a rule of thumb. And for purposes of this discussion, it's a good rule of thumb. So I go to, we do this transaction. Lane, who do I have to pick on? Because I'm going to be disparaging to somebody, and you have to pick somebody.
Oh, you can do it to me, I guess.
Fine, perfect. Okay. I come to you and say, hey, I bought the partnership interest from Ben. And you do the tax return for Y, the middle one. Isn't it Y? I think it's Y. You do the tax return. You miss the 754. Do I get to step up base of the assets? I don't. So, just so you know, this is actually very important. I've used this 100 times. This has nothing to do with this class, but it will save your ass if you miss it. You missed it, right? The 754? 301, write this down. Write this down. 301 9100-2. 301 dot 9100-2 paren 6 VI. I think. Do you have your phone, Trent? We're going to have to look this up. We'll do it in a minute. We'll do.
What's the paren, that little weird squiggly or something?
See?
Oh.
Paren?
Parentheses.
All right, parentheses what?
Can you say,
Six.
can you say it to the mic
BI.
so the people at home can hear you?
6 BI.
So it's 6 and VI.
No.
Those are the same thing in Roman numerals.
Numeral.
It's coming in Roman numerals.
Paren 6.
Is it 6? Okay. I am Rain Man. Right? So, I mean, a person shouldn't know these things or where to find it. But that says that you being a very poor preparer and missing the 754, I got a 1-year extension to do it. Because under 754, it has to be made on a timely filed return in order for you to get the basis step up. Lane missed the basis step up with the timely filed return. We can go back and amend that year's return and write 301.9100-2 paren what? 6 on there, filed pursuant to that, and do the 754 and capture it. But you didn't do that.
So then that's the reviewer's fault, actually.
That's
I was prepared.
Where's the
Okay.
cell on?
what?
Where's the cell on? Is Ben on it?
I wasn't going to say it. Okay, so that means my outside basis is 1,000,000. My inside basis is 100. That's a problem. So the next piece, which this is interesting and actually would be helpful if this ever comes up, and I have used this, is if you liquidate the partnership, okay, this is something worth writing down on the blank page next to you. If you liquidate the partnership, there's an ordering rule that says, 1, deplete basis first by cash distributed. Okay, the first tranche that you have to deal with in a liquidation is you deplete basis by cash distributed. The second is allocate remaining basis to assets received. Okay? So now, Lane has missed the 754. I didn't get the basis step up. I'm screwed. But I know this partnership distribution rule. And I know I got 3 different opportunities or methodologies under 84-111 to incorporate my partnership. And if I choose the wrong one, I miss the basis again. So if I choose 2, where I actually liquidate the partnership, was cash distributed, Lane?
No.
No. So my basis on the outside, Lane, is how much? How much?
1,000,000?
1,000,000. How much cash came out, Lane?
0.
Zero. So did I deal with the first piece of my ordering rules for partner liquidation?
No.
Yeah,
Yeah.
because there's no cash. I dealt with it. It just happened to be 0.
So,
So-
if it would have, then you would have distributed, so like, let's say it's 500,000, then you would have distributed the 500,000, but there's no cash, so you would have distributed.
So if that's true, my basis will went from 1,000,000 to let's make it 400,000 because 400,000 cash. My basis would have gone from 1,000,000. Why don't we do that just for fun? 400K,
So it'd be 600,000.
600. So what's the next rule say?
Allocate
Basis to
remaining
the
basis.
assets received
So then you'd allocate the 600,000 to what did they receive.
to the land. So the land had an internal basis of $100,000. Well, now by virtue of liquidating the partnership under scenario 2, I have now tacked on that basis onto the land. Now, but if I come over here and X is the contributor, well, what's 358 say, Lane? I'm being sincere. Jameson, what's 358 say?
It's the shareholders basis,
Sorry, 362.
corporation's basis.
Corporation's basis. What's the formula?
Gain recognized political basis.
Okay, so what's my old basis, Lane or Jameson?
The inside basis.
100,000. So when that land is transferred to R, my formula is old basis plus gain recognized. Old basis is $100,000. Gain recognized is 0. Basis in the ground at R is 100. Come over here, you liquidate. Basis in the ground is now 600. The ground is now going in the corporation. Old basis is 600. So by virtue of doing it this way, you've captured that step up that was missed under Lane's 754. So if you have an inside-outside basis difference that was not captured under 754, you can use 84-111 to capture it. So knowing these three methodologies is important. So now, the next stupid question is, I wish I had another whiteboard. What happens when we file a 2553 for PJ, which is a partnership, LLC?
S corp election.
It's an S corp election, which is check the box. So you have to run your corporate formation rules. What are those? What are those corporate formation rules, either by word or by code section? And if you don't know, call on somebody.
351,
351,
357C,
357C,
358,
358,
362,
362,
120,
1223, 1 and 2.
2, and then 168 I.
7.
Okay. So by virtue of filing the 2553,
Yeah, that's pretty good.
Ben called it. Ben says Lane gets a gift card for what I would, never mind, I was going to be a jackass. Okay, so stupid question.
Stop saying that, because then they're hard questions, and then it makes me feel dumb, you know?
Whatever. I'm not here to make you feel good about you. So if I file a 2553 and I got 84-111 with 3 options and nothing moves, Z already has the land. Which is it? Which scenario is it that just occurred? And you don't know, right? You have no idea. Under check the box, it's this one. So that's worth knowing. So if you have this inside-outside basis difference where you could actually take advantage of this rule, the ordering rule to recapture that basis, you ain't going to do it under check the box. You have to actually liquidate the partnership, distribute out the land directly, and contribute. You actually have to take those steps. Check the box bars you from doing that, and you're stuck with situation 1.
So then how do you get that treatment? You have to go to your attorney and set up the corporation
Mm-hmm. And you actually have to liquidate.
into the corporation,
No, you have to liquidate Y.
or liquidate partnership, contribute assets, and then do an S election for new corporation.
Yes. That's what has to happen.